Hey everyone, welcome back to our channel. If you're new here, I'm so glad you decided to join us today. We're here to simplify complex financial topics so you can make informed decisions in your financial journey. Today, we're diving into an important topic, the differences between fixed and variable interest rates. Whether you're looking to take out a loan, get a mortgage, or simply want to understand how interest rates work, this video is for you. But first, let me ask you a question. Have you ever wondered which type of interest rate might be better for your financial situation? Let's find out. Let's start by defining what we mean by fixed and variable interest rates. A fixed interest rate is exactly what it sounds like. The interest rate remains constant throughout the life of your loan or investment. This means your payments will be predictable and consistent, making budgeting easier. For example, imagine you take out a mortgage with a fixed interest rate of 3.5% for 30 years. Your monthly payment will remain the same, allowing you to plan your finances without worrying about fluctuations in interest rates. This can be particularly comforting during times of economic uncertainty. Now let's shift gears and talk about variable interest rates. Also known as adjustable rates, these rates can change over time, typically in relation to a benchmark interest rate, like the prime rate or LIBOR. This means your monthly payments can fluctuate, which can be both a blessing and a curse. Let's say you take out a loan with a variable interest rate starting at 3%. If the benchmark rate increases, your interest rate could go up to 4%, 5%, or even higher. This means your payments could potentially increase, which might strain your budget. Now, you might be wondering, why would anyone choose a variable interest rate? Well, often, the initial rates for variable loans are lower than fixed rates. This can lead to savings in the short term, particularly if you're not planning to hold the loan for a long time. For instance, let's say a fixed mortgage is at 3.5%, while a variable mortgage starts at 3%. If you only plan to stay in your home for a few years, the lower initial rate might save you money as long as the rates don't spike during that time. Let's break this down further with some pros and cons for each type of interest rate. Fixed interest rate pros. Predictability, your payment amount won't change, making it easy to budget. Long-term stability, you're protected from future interest rate increases. Fixed interest rate cons, potentially higher initial rates than variable options. Less flexibility if the market rates drop. Variable interest rate pros, lower initial rates can mean lower payments at first. Potential for savings if rates remain stable or decrease. Variable interest rate cons, monthly payments can increase, making budgeting harder. Risk of paying significantly more if rates spike. Now, let's look at some data to drive these points home. According to the Mortgage Bankers Association, as of 2023, about 30 to 40% of new mortgages are taken out with variable interest rates. This suggests that many people are willing to take the risk for the potential of lower initial payments. However, it's essential to be cautious. If you choose a variable rate, make sure you understand the terms. Look for a cap on interest rate increases, which can protect you from drastic changes. In summary, both fixed and variable interest rates have their advantages and disadvantages. A fixed rate offers stability and predictability, while a variable rate can provide lower initial payments but comes with the risk of fluctuations. The choice really depends on your financial situation, how long you plan to hold the loan, and your comfort with risk. If you found this video helpful, please give it a thumbs up and don't forget to subscribe for more financial tips and tricks. And I'd love to hear from you. What type of interest rate are you leaning towards? Let's chat in the comments below. Until next time, take care and happy budgeting.